Hello there, this is James and you're watching Tixee Live. In today's program, I want to discuss and ask the question whether or not we have seen the end of the declines in the stock market, or is this simply just the beginning? And a couple of other things as well. But before we get to that, don't forget these little programs or these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get to it. So yeah, my question, obviously last week, if you watched me on Friday, I was saying that the US dollar was weak across the board because there was a teeny weeny bit of risk appetite in the market, down to the fact that commodities were under a huge amount of pressure, and the market sort of was looking into it that the commodities are falling. This means we can sort of control inflation, and basically the interest rate hikes won't be so aggressive, which won't damage the economy. So we had some gains last week, and I'm going to ask the question, have we seen the end of it, or is it just simply more of a beginning of more pain to come? I mean, this week does see the end of the second quarter. Okay, the end of this week, it sees the end of the second quarter. And the S&P on Friday rose by more than 3%. And it actually gained over the week 6%. 6%. And in fact, the stock market in general had quite a good ending to the week. Like I said, we had a weaker dollar last week against the majors because of that risk appetite slowly creeping in. So I want to know if what we're seeing at the moment, is it really a change in pattern and maybe more hope coming in that we might have a soft landing and that the threats of recession is overly priced into the market? Or is it simply a dead cat bounce? I mean, if we look at it, the S&P, S&P is due by the end of this week, depending on what percent, if it does indeed rise, by the end of this week, it's still due its worst opening 6 months since 1970. In fact, it's down by 18%, and only 5 times as it actually had a worse start since 1932. So I'm beginning to think, are we giving ourselves a false sense of hope that the market is recovering? Are we seeing that these threats of recession slowly dissipating or disappearing, so to speak? And we think, yes, we can indeed do a soft landing. And not have a hard landing or a hard recession. But this week is going to be quite interesting because I think this week will give us a false impression. And I tell you why, because this week is the end of, like I say, the end of the second quarter. So this is where a lot of pension funds and hedge funds and other investments sort of balance their books, so to speak. So we might see a bit of a rise in stocks this week. In fact, actually, JP Morgan, they believe, again, this is them, not me, they believe that US equities may climb as much as 7% this week as all these pensions and funds balance their books. I think that this week we might see a little bit of optimism. We've got some key economic data to come, which may change that this week, which I'll go over. I think this week is going to give us a false impression, because I think we are due more pain. I don't think inflation particularly will come down as dramatically as we hoped. Don't forget, we need it to come down quite dramatically. So I think we might get a bit of false hope this week. Other things happening as well, which could have an impact on this false hope, is obviously the G7. Now, the G7 are getting together over the next couple of days. It's like the rich man's club, basically. And yeah, the G7 consists of these countries, all the big guys: US, Canada, France, Germany, Italy, Japan, and the UK. It's a members only club. But they're going to be discussing several things. One is going to be the global economy, whether they can have a united stance against this huge inflation problem we have across the globe. And obviously the food crisis. And of course, you guessed it, Russia. In fact, they're going to be discussing a possible price cap on Russian oil. The idea of this is hopefully they can then bring the price of oil and energies down, because this is a big, big problem for a number of these nations at the moment, is obviously the energy crisis which we're suffering. In particular, don't forget, we discussed Germany last week with their activating phase 2 of their emergency gas plan. So this is going to be a big thing. So that's going to come out of it. And already a number of the G7 nations have already banned imports of Russian gold as well. So they put a ban on that, because obviously that their argument is the gold imports from Russia generates a fair bit of money. In fact, it generated $15 billion to Russia last year, 2021. So, I'm not convinced that's going to make much of a difference to Russia. But again, that's another thing which has an impact. But be interesting to see what does come out of this G7 meeting and how it impacts the market, how the market reacts to it, and how it takes to it. Talking of which, let's have a quick look at what's going on in the market as we speak. So this is gold, talking about gold and the fact that the UK, US, and Canada and Japan are banning Russian imports. This is gold at the moment. Okay, it's still not really reacted to any news of this ban. It's currently trading at $1,835.92. Still trading between that range we've been watching, which is 1,828 potential support and $1,864.20 resistance. So it's still trading pretty sideways. If we have, don't forget, this is a 4-hour chart. Okay, if we have a look at some other things as well, we look at the euro. Yeah, the euro is still capped at that key area of interest we put in last week, 105.784. Still trading around there. Again, this is on the back of a weaker dollar, because like I say, there is a little bit of optimism as we approach the end of the second quarter. If we look at the cable, okay, the cable is testing that key level of 123.15. Okay, still fairly range bound though, still below the 100 and the 200-day moving average. RSI is between the 70 and 30, so not indicating either overbought or oversold in any way. So it's still around that key level we're watching. And that support we've been looking at as well, 121.97 is still a key area of interest for support as well. If we look at stocks or equities, S&P, again, like I say, it gained momentum last week. The chances are it may gain momentum this week as well as they balance the books and we close the second quarter out. Currently trading at 3,039 points. We look at the energies, WTI, slight bounce, but still under pressure, around $107.33. So that's what's going on in the markets as it currently stands. What else we got today? Today, this could be quite interesting. This is where maybe the happy feeling might start to disappear. We have US durable goods, and that's due at 12:30 p.m. UTC. Durable goods, okay? These are purchases of products which have a longer lifespan, not like little things like food or clothes and things like that. We're talking bigger things like cars, things like that. So that is coming in at 12:30 p.m. UTC. If we see a slowdown on that, the expectation actually is 0 for that. So if we do see maybe even a negative, that could put basically the dampers on the current mood in the market. So it would be interesting to watch that. That at 12:30 p.m. UTC. Other key events this week, I've already mentioned it several times, so I'm really excited. We've got Bank of England Governor Bailey speaking, Germany CPI, US GDP, Germany retail sales, US initial claims, again, the labour market, keeping a close eye on that, UK GDP, EU CPI, and US ISM manufacturing. So a busy week ahead of us. As the market, as it stands, the FTSE is currently up 0.55%. DAX currently trading 1.60% higher. And Eurostoxx 50 currently trading at 0.83% higher. So there we go. So it'd be interesting to see how this week turns out. I do think we might get a bit of a false illusion as they try and balance the books. Like I say, it's the end of the second quarter. We will see activity by pension funds and other hedge funds balancing the books. We might see a bit of a boost in equities. I do tend to feel, though, this is going to give us a false impression of how the market's going to be for the remainder of the year. But let's see. Don't forget, you can ask me questions anytime you wish while I'm live on air. If there's any questions, please feel free to ask me. Or even maybe you simply say hello. That'd be nice, So never hesitate to ask me anything if you have any questions for me. This is what I'm here for. Anyway, how is everybody? Everybody having a good start to the week? It's Monday, isn't it? So happy Monday. Okay. If there is no questions, not to worry. Don't forget, I'll be back online again this afternoon to do the afternoon session, discuss a bit more of this G7 summit, and also have a look at US durable goods and see the impact that has had on the market, and see if this happy feeling is maintained at the moment. So yeah, don't forget, I'll be back online at 1 p.m. UTC. Okay, so no questions. In that case, as I always say, if you're watching me on Facebook and you like it, give us a follow. If you're watching me on YouTube and you like it, by all means, subscribe if you like. Hit the notification so you know next time I'm going live. If you enjoyed this episode and found it useful and interesting, and you put up with me for being over enthusiastic about the markets, then give me one of those. It's always nice to see. But till then, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be treated as financial advice. I always suggest you do your own research, do your own diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.